All right, what a way to finish up a really strong week for the markets. And today we're going to break down. I'm going to break down the possibility that this strength can persist through the rest of this month into the election season, September, October, later here in the next couple of months. We're going to talk about the patterns that we're seeing that suggest that, and the type of pullbacks that we can get. The what would a short term pullback that would only last a couple of days, what would that look like, so that I can know what to expect. What would an intermediate pullback? What are the signs that I can see so that if we only have a down day or two, it's no big deal. If we only have if we start with a bigger multi-week intermediate pullback, that's a different story. So what's going to be the difference as we start to have any kind of weakness potentially as early as next week? So I'm going to break that down so we can identify and recognize those. And then for our trade idea of the day, if we do maintain some strength with these really strong patterns, we're going to talk about how to hedge some of these neutral trades that we've been putting on lately. So we'll talk about that with our trade idea. So let's go ahead and get started. Today is Friday, August the 7th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast indicator here. You can see we had a really strong week after last week's overbought cluster on Friday. The near-term line got even further into the upper reversal zone and stayed there all week long. So nice, good move. But you notice after Friday's range, every day's range really, really small. Maybe some gaps, but the rest of the intraday ranges just got progressively small. That's why your momentum line is just stuck in the middle of the chart. There's not really a lot of momentum because we're just grinding. At least we're grinding to the upside, and that's why the near-term line. But because we're going so slow to the upside, the market sentiment line continues to fall. The intermediate line is at the 99th percentile. I mean, just to give you an idea, like over here we hit the 97th percentile was the biggest peak, and over here the highest level we got to was in 98.37. We're at 99.08 right now. And then there's 98.005. This is one of the highest marks of the intermediate line that I've seen in in the past year. As you can see there, you'd have to go out. You'd have to really, really go out to some to see this. Let's see. Let me put on a horizontal line and edit that to 99.0834. So there's where we're at. So if I were to zoom in just a little closer so I can see a little bit better. See, we got we got close right there, 98.37. There's your 98.005. And then we keep going out. We got close there at 97, just under 98. Right here, we got the 98.5, and here we got the 98.7. Didn't get that high in any of those levels. Here, we got to 98.9 right there. And it's again 99.08. So that's about the closest we got. Here we got to 99.3. So this is the highest level on the intermediate line that we got to since October the 5th of 2017. So October the 5th of 2017. Let's go out and see what that looked like. Really quickly, here we go. So right here, October the 5th of 2017, right there. So that was actually we got to 98 on that run. That was coming off of this intermediate pullback, very slight intermediate pullback. We started this intermediate run. It was at the beginning. We were only really pretty much a month in. And then you can see the late rallies that we got. So this was our big 5-month-long intermediate run that really kind of came off the wheels fell off there in the first quarter of 2018. And you can see we retouched some of these up. It got really high in 2018, got up to that 90, almost up to 99, 98.9. So That's probably more like what we're seeing right now is this kind of a move where, here we were very mature in the trend, very bullish. You can see the near term line. We had a good week there coming off of option, or it's coming off the beginning of the year actually. Very good week there. And that was actually the beginning of a big, long near term run. So this near term rally in right here, we started with one day. This was the first day of the near term rally. We were at 49 there. We got up to 98 there. So 1, 2, 3, 4, 5, 6. And on that fifth day, or fourth day, fifth if you include this 49.8, we had gotten up to a really high intermediate line. And then, so 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 16, 17, 18, 18 days of this intermediate run. We've seen 20. It's pretty rare to be too long, but that kind of gives you an idea that, okay, here we are in this midst of this intermediate rally, very mature. We're going on 4 months now. We're almost done. In fact, the 9th looks like, April the 13th was the first day. So we're, next week will be 4 months complete of this intermediate rally. This might be kind of a last hurrah, big, long, near-term rally that leads us up into the end of August, where we might start getting some retracement, some volatility towards the beginning of September. That's kind of my expectation is by the beginning of September, we'll be back into this area here so that the rate of change chart and I've showed you this before, but the rate of change chart here, which is now at 14% on the 3-month basis. Once this becomes the basis for the beginning of the 3-month period, I think the rate of change will it's going to eventually work its way to zero. The question is when, and I think that's kind of an idea. That's a good solid. That was kind of a blow off top for the time. This was kind of an intermediate pullback, even if it wasn't necessarily by definition one. So I think by the beginning of September, we might work our way into that area. That would actually be 5 months long. And if we don't work our way by then again, that will be a really, really fast. Let me show you that 2017. So the rate of change, instead of coming down from relatively high levels, not as high as we're at right now, but instead of coming down to zero, we had that last leg higher, and that pushed us up to really, really high. Got up to 12%. We're at 14 right now, but 10% is kind of a key level that once we kind of break that 10% mark, then we're headed to zero, in my opinion. It's just a matter of how fast and when we're going to get to and where the beginning point will be. Like I said, this ends up being a pretty decent beginning point because of the blow-off nature of that move that we got up to that peak. So just kind of keep your eyes on that for the upcoming future here. But very strong intermediate trend across the board. So, I mean, look at 93 for the Dow, 97 for the NASDAQ, of course. That's really high. Its market sentiment's falling, but at least it's still above 80. Its near-term line's actually falling, so you're starting to get some weakness in the NASDAQ. And then, of course, look at the Russell. The Russell's at 99. I mean, the Russell, which has been so bearish, and it's kind of breaking out here above its 78% retracement level. So, finally, it's starting to show some legs, that it's got some opportunity to catch up. And that's what happened here, right? It caught up to where the rest of these indexes were. So I'll move this up to this new high point. So that's something to keep an eye on too, is, this might be the sign of, the end of this current intermediate run as we kind of get a new strong push on small cap stocks that were up 1.5%, whereas NASDAQ stocks will kind of slow themselves down a little bit, down 1% today. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel, mouse over our logo, or this icon, right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us there on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us you liked our videos, and it tells us you want us to do a video again. If you like our videos, you want to let us know, you can do it with one click. You can do it right now while you're watching. If you don't like our videos, of course, you don't have to click on anything. Also, while you're down there, comment. What questions or comments do you have about anything I discussed in the video tonight? Post those down in the comment section. Join our website at marketscholars.com. There's a link popping out right there, top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us on our website, we invite you to check out some other things here on the side. Check out our Market Outlook live videos. Every day I do a Market Outlook. I also do a live video on YouTube and review all of our old trade ideas. You can get to that right here. That's for all of our monthly subscribers and our premium subscribers. Also, you can see all of our classes here. Our monthly subscribers get access to all of our trading rooms, all 8 that we do every week. In addition to our trading rooms, we have two Q&A sessions. One that I do, you can see here tomorrow morning, and then one that Brandon does. Our premium subscribers get access to those in addition to the trading rooms. Also check out down here, click on this heart. It opens up a new window. Hit that like button right there. Also hit this thumbs up. It takes you to your Facebook page. We also invite you to click that like button right there. Again, the more likes these posts have, it benefits us because Twitter and Facebook will promote our content that has a lot of likes to all of our followers, even if they're not on when we post our Market Outlook posts. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you with 1 click, 2 clicks here to engage with us right here. All right, let's get back to the charts and take a look at the long-term chart, the weekly chart, and look at that breakout on the S&P. Very strong candle there, and you see that all across the board. Not so much on the Dow. We didn't close above the highs, but still, after transition candle, to get a bullish candle is very strong, especially now 2 weeks, 3 weeks into this golden cross. Very strong breakout on the NASDAQ, closing above all 3 of these highs here. Again, a Hakinyashi close above the previous week's highs is much stronger, a lot more bullish than just a regular close up above that. So keep that in mind. And you can see the Russell 2000 just barely getting a crossover now, a golden cross. Very strong bullish. Still needs to get through the 78 and close above these highs, but very good bullish candle there. And you can see the Russell's got some opportunity here, and we'll talk about that here a little bit more in the video today. Let's take a look at the 3 green arrow chart. As you can see, we continue to have 3 green arrows on the S&P 500. We're trading up above the 8-day moving average, well above the 17-day. Even with the weakness we saw in the Qs today, that's all it did. It just got back to the 8-day. Remember, getting to the 17-day is we don't really start worrying about any protracted weakness until we get below the 17-day and then stay below the 17-day for more than just a couple of days, right? So you get down below it. If we don't pop right back up above it, like we did these 2 times, then you're worried, right? Over here, we were kind of a little bit of a concern, but then we popped right back above it here on the June 30th, and we've been riding up ever since. So that's when you really start worrying about any kind of weakness. And we're not to that point yet. If you look at the IWM, we're actually pulling away now finally. So, and if you look at in terms of how bullish are we? How far up above that 30-day moving average are we? Are we getting kind of to an extreme here? So let's take a look at the 1 and the 30, and then look at the simple. And you'll notice, we're at 4%. That's the 84th percentile. So we're relatively high. We've been higher. You can see both the dotted lines. We've been higher, but we're not nearly as extreme. In fact, in the last 5 years, you can see, we're still in the 84th percentile. So we're pretty bullish, right? These peaks were 4% above. These peaks got 8% above the 30-day moving average in June 8th. That's when things really got haywire. Another really high level that we got to in 2018, or the beginning of 2018, we got up to about 4%, just over 4% above. So above the 30-day moving average. So that kind of gives you an idea that we're pretty bullish right now. We're not nearly as extreme as we were. This one was almost over 6% above. So we're not nearly as bullish as we were before, but still, that's pretty decent, right? That's pretty decently bullish. It doesn't necessarily mean that we have to go down. It just means that this week was a grind, and expect more of a grind. If we stay bullish through the end of this month, I just expect more of a grind for us to go forward here. As you see, as you take a look at the intraday chart today, you'll notice that we still haven't filled in that gap right there, or this gap from Monday. So we got a couple gaps here this week. Monday's gap, there's a little bit of volume on that gap. If you take a look at Monday's volume compared to the rest of the week's volume. Well, here, let me get to the 3 green arrow chart. Right here. So if you look at Monday's volume, that was relatively high, and then today's volume was pretty decent too. Ended up being pretty strong by the end of the day. About 57. We were riding really low for a long time. Ended up with 57 million. So so these, I wouldn't necessarily qualify these as runaway gaps. They're just kind of common. So, and we are well up above, like the value area here is down to 327, so it's down to the bottom of that gap. So it's pretty easy for us to come back down. There's not a lot of support of volume in this range. So if we pop back down to 327, that would fill in some gaps here, like say early next week. But keep in mind, from a 2-line version on this chart here, where's 327? Well, 327 would be still be below the 8-day moving average, but it would still be around the 17-day. Remember, we can pull down to the 17-day and not skip a beat. It's when we get below it and stay below it, that's when you start worrying about, again, the beginnings of an intermediate pullback. So watch for gap fills to occur, at least this Wednesday gap, which would get us below the 8-day, and then the Monday gap would be flirting with the 17-day. If that occurs, we get a little bit closer to the 30-day moving average. We're not so overbought, but actually it will give us an opportunity for another kind of leg like this to the upside. So don't get too worked up if that ends up happening. Again, even as early next week, because of how bullish we are here. But I don't think necessarily that we are doomed to the beginnings of an intermediate pullback on the next drop to the 17-day. I still think we have some opportunity to continue to run. I think you'll have some outperformance in small caps during that before we get another leg higher with potential of the Qs leading us back up. If we keep grinding, if we keep taking off like a June 8th type thing here, if we keep taking off with small caps and we pull way far away, then we know, okay, when we get down to that level, we're more likely going to. That was a 23% retracement that didn't get through the 30-day moving average. The next 23% retracement will get through it. So we don't necessarily want to see that. But if if that happens, then we know what to expect. But the more likely scenario is that we probably pull back down and fill in these gaps sooner rather than later. Test that 17-day moving average, turn back up again. Partly because of like how low volatility ended up closing. Volatility closed below 80% for the first week in a very, very long time. The last time we closed below 80% was November, and that started a run in volatility that started to pick up even before COVID hit. But by the week of February expiration, before things really hit the fan, that next Monday, we had closed at above 95%. So very, very low levels. I would expect because of that we'll get at least a small pop. Like I said, maybe not to like the 40s, but maybe up towards the high 20s as we retest that 17-day moving average. Like I said, again, as early as early next week. All right, so to summarize the technical outlook, we have a strong bullish posture. Nothing has changed in that regard. We are not extremely overbought like we've seen in other cases, but we're pretty strongly overbought to the point that, as early as next week, we can get a short little pop to the downside. Maybe the near-term line drops below 50, but I don't even think we would get like light green, light pink shading in the market forecast. We might close maybe a day below the 17-day moving average, but nothing too concerning. I still think that we still have maybe a few more weeks left. I unfortunately think that we're headed towards, like a 4 plus 5 month long intermediate run here. The momentum is just really, really strong. We're lacking a catalyst to start the sell off as of right now. And we know that those aren't necessarily the greatest things. Eventually, all intermediate lines, the intermediate line doesn't stay above 50 forever. And the longer it does, the worse it is when it does eventually drop below 50. So unfortunately, we're gonna have to deal with the ramifications of that later. But in the meantime, I still think we have a few more weeks of bullishness to continue to ride to the upside here. Maybe with some change in leadership. We might have some leadership changes. You'll see here in a second with small caps that might lead us on this last leg higher, and we'll see how that plays out. But even an intermediate pullback wouldn't be the end of the world either. So I'm not looking for I don't think we're going to have another Q1 of 2018 or Q4 of 2018 on our hands again, or of course, what happened with COVID with 34% drop in 4 weeks. I'm not looking for that kind of intermediate pullback. I'm looking for like in May of 2019 where we kind of settle down for a few weeks and pull back to 38% retracement, find some support, and there's going to be a lot of it, and then bounce back up eventually. And it might take, it might last a little longer because of the election cycle that would be coinciding with the timing of that intermediate pullback. So that might throw a little wrench into the timing of it in terms of making it last longer. I don't think that would make the pullback deeper. I think it would just make it last longer. So we'll see. We'll see how that plays out. What do you think? Do you agree with that? Do you disagree? Comment down below on your thoughts. And especially if you disagree, share with me your thoughts on why. Like, what are you seeing that suggests why you're either a lot more bullish or a lot more bearish than I am? All right, now let's talk about what's driving the price action. Let's look at how the different asset classes perform just this week. So let me drop down to August, and we'll look at the beginning from Monday. It's because that includes the Monday gap. So we gapped up on Monday. Eventually, small cap stocks had a great week, and it was mostly at the end of the week where they really kind of separated significantly. Big jump on Wednesday, and then another big jump here on Friday. But 6% gain on small caps, 2% gain on Qs, lagging behind SPY by the end of the week. Commodities are up. The dollar was relatively flat, was down for a good chunk of the week, was relatively flat. You can see bonds finally had a down week. That's been kind of a rare for bonds. And even with the weakness in the relatively flat nature of the dollar, gold was up 3%. It was up a lot more when the dollar was down 2/3 or 3/4%. Gold was up. Gold was kind of matching small cap stocks, interestingly enough. You can also see emerging markets too had a really good run, but it was today. Today's big kind of turnaround was the dollar, right? The dollar ended up that's a very strong move for the dollar. 0.75% in one day is a very, very strong move. Didn't phase real estate or small caps, but it did phase just about everybody else. So you can see especially gold and especially emerging markets, commodities too. I don't think that's trend changing. The dollar's been and is very extremely overbought. Or excuse me, the dollar is extremely oversold. If you take a look at the Euro US dollar, which is the most liquid currency pair out there, a little bit of a evening star candlestick pattern, some kind of reversal, bearish divergences. So, we might end up, this is a bullish intermediate confirmation signal. So if that bounces up early next week, then whoa, here we go. You'll just see everything just reverse again to the upside. But, we might pop back down to 23% retracement. Remember, that's just noise, right? Between 0 and 23 is noise. It's just a big gap because the move was so big to the upside. That would probably produce light pink shading, but you notice it would not produce a yellow line because we're so far up above the 30-day moving average. So I wouldn't be surprised if the dollar had a bullish week next week. If that coincides with the beginning of an intermediate pullback, then we'll see how that plays out. We'll probably get a bigger drop in this pair down to the 38%. But more than likely, we might just get a little bit of a drop here. And like I said, that might pull the S&P down to its 17-day moving average. and then that's it, right? And then that would be it, and then we would maybe the dollar and the euro dollar will trade between the 0 and 23 level, kind of slow down a little bit as the green line as the moving average catches up. That's kind of my expectation for that. That's impacted things like gold, right? You can see, gold here. Gold, a little bit of a bearish engulfing pattern as much as you can have on a futures contract. It's been very bullish. You got this tremendous divergence on the near-term line that can play out to at least down to this 1970 level. So if you're looking at like when this intermediate run really started, you kind of started with this low point down here. You make your run up to the high. So, you can pull down to 1995, just below 2000 again. You might break down below that, kind of sucker some people thinking in that this is a fake out type move. But you'll get some support in this Fibonacci retracement zone. Of course, the biggest support, depending upon the strength of the dollar, the biggest support would be down here to 1830. So we'll see how that plays out, and that would be, if we got below to 1830, that'd be an intermediate pullback here on gold. But more than likely, again, we're very far above the 30-day moving average, which makes it very easy to trade between 0 and 23%. So again, if the dollar pulls back, or dollar bounces, then you'd expect gold and commodities to pull back as well. Crude oil has just been really, really very, very low volatility, very, very tight and small ranges here. So it's kind of like, are we going to get some kind of breakout of this? Considering how tight it's been. If you look at its ATR, you can see visually how far its ATR has pulled back down to, after this really extreme lows and big moves to the downside. Since then, after the bounce, they stayed pretty high after the bounce, but now, back to levels, way as we saw back here, and really, we're at 3%. That's kind of the norm for where it typically is during bullish moves. We'll see if we get some kind of breakout on that. As we notice, if I take a look at the futures volume, we are into the value area, and when you are in the value area, this point of control will act as a magnet. It's a center of gravity. So we'll kind of watch to see if it continues to grind. Very low bandwidth suggests a breakout is forthcoming. I would expect the breakout would be to the upside, up to 55 in this area, especially if inflation expectations start to ramp up a little bit, which again is something else that brings up is yields, the move that yields have had. So you can look at the weekly chart. We've had a lot of negative weeks. Here, let's do the market forecast instead, and then look at TNX. We've had a lot of negative weeks. There's today's move finally. 4 in a row of negative weeks in a row. Well, we didn't get a negative week this week. It was a positive week, and we got a relatively long lower shadow coming off of a cluster. Remember, that was not just on the weekly chart, but also on the daily and the monthly chart as well last Friday. So, there's some opportunities. You're not going to get a very long lower shadow here because, the convexity or whatever, the idea that you just get smaller and smaller moves as you get lower and lower. Like very smaller moves on low yields have bigger impacts than similar size moves up here with higher yields. So these are tremendous moves, even if they look really small on the chart itself. They're tremendous moves for bond prices. These very small moves in yields. So you're not going to get long lower shadows, but that's about as long as we've seen, especially on the upward week. So we'll see, and again, coming off of clusters, and as low as we've been, we'll see if this plays out into a bounce back up at least to the moving averages here, and see if we can't get a period of light green shading again, and eventually maybe a yellow line that we haven't seen here since back in December of last year. All right, now let's look at how the sectors are performing. So we talked about how small cap stocks had their run this week. You can see here these other cyclical areas. Let's see on the 1-year chart. These other cyclical areas, they also had a pretty decent week. Look at financials making a run at the end. Industrials having a good week here. Energy stocks finally also made a run. run early and then kind of held a lot of those gains. You still see your technology and communication services and discretionary kind of matching or beating the market. Your safe havens all lagging behind. This is a risk on week, and it's a risk on week in terms of a move towards these cyclical areas that have not been doing as well, right? Prior to this week, if I just go back to like say the last 3 months here, technology has been and communication services and discretionary have all been the big winners, and industrials have been pretty decent too, and they're really making a run here. Materials as well, economic sensitive growth areas, financials lagging, energy really lagging. So there's some opportunity in some of these other areas, while your staples just kind of, those are good returns for a 3-month period. 10%, those are pretty decent returns. They're just lagging the market, which is what you would expect, and that seems to be the case this week. We continue to be on kind of risk on mode from a sector rotation standpoint. To show you the 12 grid here for the sectors, there's our strength right up there at the top, all 90s in the intermediate line. But now everything's dark green and green. Now we don't have green lines everywhere. We still have a yellow line in energy, but everywhere else green lines. So that's broad strength right there in terms of being bullish. And we don't necessarily see that globally, but we're starting to see more and more. If you take a look at the 12 grid for the biggest economies out there, look, we're getting remember how it was all this checkerboard before? Now we're getting a lot of dark green shading and green lines, very bullish. Even China is close to having dark green shading because we're almost above 50, and it's got a yellow line there with today's pullback. And then Brazil is the only other one. It's at least it's above 50, and it's got the bullish pattern. This is a bullish pattern, light pink shading and a yellow line. So even those two are probably as bullish as they can be right now, and close to joining. So very, very broad bullishness all across the board here. Kind of hard to break that kind of momentum without a significant catalyst. Doesn't mean necessarily that we'll go up forever, but it does mean that until we get a catalyst, considering how bullish we've been, the risk-reward scenarios, just expect slow grinds with the occasional pullback that we might get like early next week to the near-term basis, and we might get a light pink shading here or there, but nothing significant yet, at least from what we're seeing with all these other sectors and broad markets here. All right, so that brings us to our trade idea of the day. So let's take a look here at our trade idea. So let's start off on the market forecast chart. This is a stock actually that we currently have a iron condor on, and that is FedEx. FedEx, it's got a cluster here, not necessarily early on like you would have right here, but you can see its market sentiment line is also above 80. We're not early in this trend, but we're also not necessarily late, and we're getting a breakout to new 52-week highs. So a little bit of a breakout pattern that we're getting. Very bullish patterns across the board on all these indicators. We've been very bullish on the Ichimoku cloud, up above 5. We're just continuing to grind higher. You take a look at its DMI. The DMI suggests that we're very, very strong. Like we're pretty strongly overbought with the near-term line, a positive index above 40, negative index all the way below 8. But if you take a look, it does have. I come back to the Bollinger Bands. We are breaking out above the positive, the top. We haven't been able to break out of this value area for so long, but we're breaking out of this value area with good volume today. Earnings is coming up by September expiration. I've got this iron condor already, so if we pull back down towards the value area, especially by August expiration, we're fine. But if we say, okay, if this breakout is something more to come, and if you take a look at linear regression here, we are breaking out also of this 1 standard deviation channel to the upside. So it's kind of a little bit of a breakout. It might be a trend changing breakout, especially considering that we've been so bearish on this for so long. We're just getting this golden cross, and considering the volatility, we've got some opportunity to make a run and catch up, especially where the rest of the market is. Which is, remember, the rest of the market is, the S&P is well above its fall 2018 highs. There's its fall 2018 highs. The S&P is well above that. The FedEx has been a big time laggard, right? And especially way down below its early 2018 highs. So a lot of room to catch up to the broad market as a whole, and it's just barely getting some very strong positive momentum. So you say, okay, well, the nice thing is on this kind of a trade, I've got an iron condor already. We can say if it pulls back down, then I can get back to my $644 gain. But if it goes up, continues to go up, then I know I'm going to lose. I want to lose 644. I could lose 1100, but I don't want to lose that much. I only want to lose what I'm trying to make, no more than that. So 644 is what I know I can lose to the upside. Well, if I go out here and say, okay, well, if I go out to September, so a month later than the iron condor, and buy out to the 210, or sell the 210, buy the 200, so that gives me this trade. Let me say, okay, well, if we pull back down towards here, towards, in the middle, then I know that I'm going to lose a couple $100 on this very, very cheap trade. And here's the September expiration. Cheap trade. And then I know that this isn't going to work out. So because the max gain will come outside of this one standard deviation, it's got to really make a decent move. It's got to continue to make a decent move for us to be able to get that. So I can keep my loss really small and then end up with about $400 of gain from the condor and this vertical combined. If it takes off, remember, I'm going to lose 644 on iron condor, but by August expiration, if it takes off to above 200, and we got, it can get to around 200, I would be if it got up to that point, I would have about as much gain here as I would have lost in my iron condor. So I can net out that gain plus the potential that it can keep going up by September expiration, and I can get up to a $2,400 reward minus the $600 you're losing on the iron condor. So it's a way to kind of hedge my iron condor with a really, really cheap but very good reward risk ratio in the stock that has a very decent potential for breakouts. Breakouts to the upside. That was pretty flat and looking good for a while, and that's why we did the iron condor. But with the breakout today, kind of throws that upper end into question, and so this is a way to kind of hedge that upper end with a pretty decent bullish move to the upside. All right, so that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums on our website. Open up any new thread with questions or comments you have. Reply to other people's threads, and let's keep this conversation going in between videos. Again, thank you for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon on the YouTube, as well as on the Twitter post and the Facebook post. And also comment down below and in our forums on today's video. Again, thank you for watching. Have a great rest of your weekend, and we'll see everybody on Monday.